If you had planning with diversification, and I know that's kind of old hat in regards to the diversification side where you kind of take the edge off and different things along those lines, but I remind people because obviously Keith, you did a great job mentioning the planning aspect and giving people those long-term perspectives. But sort of behind the scenes, and certainly in front stage too at times, but just being diversified, because I think people hear, or as you mentioned about those headlines, they'll say like, oh, market's done this and this is down and that's down, and sometimes they automatically think that, oh, my portfolio or whatnot must be just as much down as what that headline says, or the Dow drops this or the NASDAQ drops that, and it's like, okay, well, yes, the markets did that, but maybe not necessarily your portfolio. When we use risk hedges like those fixed annuities or bonds or any other proxies or ones that will kind of take the edge off, you realize, especially when you do these reviews, as you said, when you are sitting down with people, you're able to just to say, look, yes, this is what happened in the overall market, but here's how you or in your mix actually performed. And more often than not, I think that also gives them a good feeling to know that they're not necessarily falling as much as the general market.
Yeah, again, it just comes back to that word confidence, revisiting that plan and, instituting that plan, and then doing what we're here to discuss today is, starting to look at opportunities as we exit 2022 and, enter 2023. What could people be doing? And one of the things that we're doing internally as the year goes on is looking at money that is after tax and harvesting losses. And what that means is you're purposely selling losses, and some people will shake their head and be like, why would you ever do that, right? It's more on positions that you don't feel confident in or maybe aren't confident in over the next 30 days, because there is a rule that is in place that you cannot enter that same position for 30 days. It's called the wash rule. And if you're confident or you have a feeling that the market isn't going to do well or that position's not going to do well over 30 days, but overall you do like that position, you can buy it back in 31 days and take that loss. And what that means is you can use that loss against any future capital gains, sale of property. I'm dealing right now with a family that sold the property up north, and they have a pretty sizable capital gain. So what we've been doing since we've been working together in July is every time there's a loss, we're taking that loss because it actually helps them and then repositioning the asset. So it's a really nice way to bank some losses, to potentially use that against future gains. And then in the future, as you need distributions, there might be the ability to get that money tax-free if you do it right. So there's some really unique ways, and we believe wholeheartedly in tax loss harvesting. Again, it's a position-by-position outlook. It's something that you want the client on board with, to educate them first and say, look, this is why we're doing this, and this is what we're thinking of doing. Do you agree? Yes. And then you execute.